Right now, consumers really just don't feel like they're thriving, in spite of the fact that a lot of labor market indicators are strong. GDP continues to grow. Consumers just feel really weighed down by the negative impact of high prices, and overall, they're just not feeling like they're thriving. Historically speaking, we're below average level of sentiment. Looking at the average since 1978. However, we're still about 30% above the trough that we had reached in the middle of 2022. So not as bad as 2 years ago, but not feeling like we're thriving. We have these really strong asset market and asset prices, and that's not something that's enjoyed across the population. And so I do expect a widening of wealth inequality coming up ahead.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. If you listen to the politicians in the headlines, you'll hear a lot of talk about the, quote, strong consumer who's keeping the economy happily chugging along. But when we hear from actual consumers themselves, we often hear a very different story. The majority of households are struggling under the surge in their cost of living post-COVID, and many express despair that the American dream is now beyond their reach. For a detailed dive into this critical topic, we're fortunate today to speak with Joanne Hsu, director of the widely followed University of Michigan's Consumer Sentiment Survey. Joanne, thank you so much for joining us today.
It's a pleasure to be here.
It's a real pleasure to have you, Joanne. I'm really delighted and honored that you responded to my outreach and were willing to come on this program. We cite the UMich consumer sentiment data all the time when it comes out. It's highly influential. And I do think it's particularly important right now where we sort of have this divergence between kind of, like I said, what the headlines are telling us, but what real people are actually saying. And I read some articles recently where you were kind of helping dig beneath the hood into the consumer sentiment data to really sort of give a truer light on what it's saying. Super excited to dig into that with you. So I guess let's just kick off with a tweak on the general question I usually start these conversations off with. What's your current assessment of the American consumer's level of confidence in their future financial prospects?
Right now, consumers really just don't feel like they're thriving, in spite of the fact that a lot of labor market indicators are strong. GDP continues to grow. Consumers just feel really weighed down by the negative impact of high prices, and overall, they're just not feeling like they're thriving. Historically speaking, we're below average level of sentiment. Looking at the average since 1978. However, we're still about 30% above the trough that we had reached in the middle of 2022. So not as bad as 2 years ago, but not feeling like we're thriving.
Okay. Now, 2 years ago, we had shut down the global economy. Understandable that there would have been a pretty sizable trough
Well,
there.
after that, mid 2022 was after the
You're right.
economy started to open, but inflation was spiking.
Right. Inflation was spiking and people were probably still a little
Yes,
PTSD from that point in time.
exactly.
Okay. So let me ask you this. Where do you see the trajectory of expectations going? So they're low, they're below mean, but are they worsening or stabilizing or on the mend?
It's actually pretty hard to tell right now. So overall, we have been on a general upward trajectory since the middle of 2022, as I mentioned. And the improvement in sentiment had stalled a bit in 2023, concurrently with the inflation slowdown stalling as well. By the end of 2023, there was an enormous surge in sentiment, and that stabilized over the first few months of 2024. But in the last 2 months, in May and June, sentiment has come down about 10% again. So I think consumers aren't really sure about what's happening ahead. A lot of consumers are mentioning uncertainty from the election. So I do think we are up for some bumpy times over the next year.
Okay. Now you mentioned earlier that you said, despite sort of the strong labor data, consumers feel like they're not thriving right now. I'm curious if you have an opinion on the trustworthiness of the labor data. We've a number of the experts I've had on this channel, and I have talked about some of the numbers that maybe seem a little bit hard to believe, and we certainly see lots of revisions. We usually get a blowout number, but then they downgrade the previous month's blowout number, and it's actually a lot less impressive. And I'm certainly definitely hearing anecdotally, sort of through the social media channels that this channel has, that when asked, most people are saying, "Hey, it's much tougher out there than we're being told." When especially when Jerome Powell gets up there and says, "Labor market's strong or very strong," and we still have way more job openings than we have applicants for it. Again, this is largely anecdotal, which is one of the main reasons why I wanted you to come on and give us a data-driven answer. But a lot of the anecdotal we hear from people across the spectrum, blue collar, white collar jobs, is, hey, there's a lot of hiring freezes out there. It's actually really hard to get companies to even respond to outreaches right now. It doesn't feel like a very strong labor market the way that maybe it felt 2 years ago, labor market wise. I'm curious, what does your read of the data say?
I mean, I think all of these things can be true at the same time, where there might be a lot of job openings, there might be still, strong labor markets, but at the same time, it may still feel like a challenge to get a new job. And we are still hearing, we periodically hear news about layoffs in specific industries. I'm not really an expert on the macroeconomic labor market statistics, but what I can tell you is what consumers think is happening in the labor market. We ask a number of questions about where people think unemployment is going, their own prospects, the probability that they themselves might lose a job over the next year. We ask questions on where they think their incomes are going. And overall, all of those indicators have been relatively strong. Consumers have been expressing pretty positive views about the trajectory of unemployment rates when we ask about them, and they are expressing pretty positive views about the security of their jobs as well as their future income growth. That being said, in general, people aren't necessarily expecting their income growth to outpace inflation, so they're not necessarily expecting real income gains, just nominal income gains. But at the same time, I think consumers recognize a strong labor market. In recent months, however, consumers are starting to express some concerns that unemployment might be moving in the wrong direction. We are seeing a slight deterioration in unemployment rate expectations. We'll have to see in the months ahead whether or not that sticks.
Okay, all right. Well, that's really important, because I don't want to give a mistakenly overly negative view of what's going on in the labor markets. And so your data is a good check on that. I guess what I'd love to just sort of ask, maybe I'll get to the punchline of this interview, which is if you see any notable change in the trajectory in any of this data, in future months or quarters, Joanne, would love to have you come back on and let us know whether it's a resurgence of positivity or that things actually really start taking a negative downturn. Okay, so I've got some other questions around the data. But first, maybe we can just take a minute and talk about the methodology behind the survey so people actually know how it's created. Can you give us just the quick précis of that?
Absolutely. So the University of Michigan Surveys of Consumers was established in 1946. And so we have a very, very long history of measuring consumer attitudes and consumer sentiment. We've had a pretty recent methodology change, though we do change our methodology periodically in response to changing trends in the survey data collection world. And for many years, our survey was conducted over the phone, first landlines and then cell phones. And the fact is, people don't answer their cell phones anymore. And it doesn't really matter if you throw more money at the problem, people do not want to answer the phone. And so we are currently in the middle of transitioning from phone interviewing to interviewing via the web. And starting in July, we will be 100% based on web interviews. And we did a tremendous amount of research. We started actually in 2009, investigating the viability of collecting data like this via the web. And since 2017, we've had a full parallel data collection of doing the entire survey by phone and the entire survey by web. And what our research showed is that the time series correlations are really high, and the time series has been preserved even with this transition to web. So with web, we have a lot of opportunity for innovation. So it's very exciting. We can target specific populations much more easily. If that's something we wanted to do in the future, we can increase the sample size. We can give people visual aids when they're doing the interview. So it's a very exciting time for the survey.
Oh, congratulations. Yeah, that sounds like it could be sort of like a, transformative milestone that enables you to do an awful lot more with it going forward. And it sounds like there really isn't a material sort of digital bias there that skews the results in any meaningful way versus the phone.
Not really. So it is the case that for some measures, people give slightly less positive responses on certain attitudinal questions over the web than over the phone. And we saw the same pattern when we switched from in-person interviewing to telephone interviewing in the late 70s. So this is known. The more distance you have from an interviewer, you might give slightly more negative responses. However, the differences are very, very small. And we phased in the web data 1/4 of the sample as a time over a 4-month period to ensure we would maintain the time series integrity. And there are a lot of variables where there's no change at all. Basically for inflation expectations, those are the numbers that are closely followed by the Fed, policymakers at the Fed. That basically that has very, very little difference, or a negligible difference between phone and web. But we
Okay.
post all of the phone and web data on the internet for anyone who wants to dig into the gory detail. But overall, you can continue to interpret the time series data as it is.
All right, great. But yeah, for the data geeks, it sounds like you put it all out there for them, which is great. I know you said the differences are really small. I'm just curious. Do you think the differences it sounds like you said people get a little bit more negative the further away they get from their connection to the interviewer. Um, could do you think it's more, I know it's a small difference, but could you say it's more accurate, meaning that people are answering more truthfully, because sometimes there's the interpersonal dynamics that maybe influence you to not want to be perceived as a downer or disappointing the interviewer?
I think so. I mean, I think the respondents are now, people who are interviewed can now do it without any concerns about judgment. And I think it would be completely understandable if you have an interviewer who you see smiling at you, or you can probably hear them smiling at you
Mhm.
over the phone, that might influence your results a bit. And so, I think what we're getting is more unvarnished from the consumer.
Okay. All right. Well, talking about unvarnished consumer results. So I'm going to pull up a chart from your recent survey here. And this goes back to what we were talking about at the very beginning, which is that people are citing concerns over their financial prospects. As you said, they don't feel like they're thriving. They are saying that inflation rising faster than their wages is a big part of that. They're not keeping up with inflation, I guess is the way to say it.
Yes.
And then we're seeing something here in this data that I've been talking about a lot with a lot of the other experts who appear on this channel, and I'd love to get your thoughts on it. We appear to be seeing the same bifurcation here in the results that a lot of other experts are seeing elsewhere in the economy, which is we kind of have a top percentile that is doing great. And these tend to be, the affluent who own assets that have really benefited from the asset price inflation that we've seen right now. So they're usually generally making good livings, but they're also making a really good return off of the assets that they own. As you go further down the socioeconomic spectrum, asset ownership becomes a lot narrower, not smaller. And these people kind of get all the cost of living damage, but they don't get much benefit from their assets pulling them up. And therefore they're doing less well. It seems like we see the same thing here, right? So, but the middle class and the middle tercile and the bottom tercile, their charts are substantially higher in saying that, hey, high prices are killing me, where we're actually seeing more or less of a descending trend in this with your top tercile. Am I interpreting this correctly?
That's absolutely correct. Consumers who who are in the top tercile of incomes, they still don't like high prices, but that is easing quite a bit since its peak in mid 2022. In contrast, for the middle and lower income folks that we see, that really hasn't abated a whole lot at all. So there are two things I want to point out here. So first of all, this bifurcation is not new. When you're looking prior to the pandemic, you see that we've long had quite a bit of difference in the share of consumers, telling us about this. And if you look at consumer sentiment overall, you see a similar pattern where higher income people tend to have higher levels of sentiment than lower income people. And also take this opportunity to note that we're not just a survey of college students, as some people sometimes think, but probably not your viewers. We are covering, a nationally representative sample, and so this income gradient is not new. It's been there for a really long time. What's actually unusual is what happened in the wake of the pandemic as inflation started to rise. Consumer sentiment and also these complaints about high prices as a reason for poor personal finances, that converged across income group. And that is not something that has happened that many times in history. So it's this convergence between 2021 and the end of 2022. That's really unusual. And now we are back to this bifurcation and back to this strong inequality that we had been seeing in previous decades.
Okay, I want to dig further into this inequality if we can, and I want to start, if I can, by reading a quote, I believe, of you in a recent Fortune article about the recent UMich data. And you said, my interpretation is that consumers see a lot of aspirational goals that we talk about as part of the American dream: home ownership, paying for college for your kids, having a comfortable retirement. With high prices and high interest rates right now, those aspirational goals just feel increasingly out of reach, right? So basically, more people, it seems, are kind of giving up on ever being able to achieve the hallmarks of the American dream, as you said. And I guess my question for you is, how worried are you about this when you have an increasing percentage of your populace really beginning to feel like the social contract is getting broken, that no matter how hard I work, I'm just not going to get ahead? I mean, history shows when a high enough percentage of your population gets to that point, good things don't happen after that point. Are we anywhere near like a real worry point for you, or is this just noise within the signal at this point in time?
I think we're somewhere in the middle. So, my interpretation of the data is a way to square two things that are happening that's kind of unusual. One is we have, as I said, below average levels of sentiment, and at the same time, we have robust consumer spending. So I think there've been, a few possible explanations that have bandied around, including high interest rates, but high interest rates, we've seen high interest rates before. And during those periods, we weren't seeing low sentiment and high consumer spending. So I think this idea that aspirational goals are becoming increasingly challenging, I think, given in particular the high cost of higher ed and the high cost of housing and insurance, I think that is one way to square the circle. In terms of how worried am I? So we've already talked about how higher income families, their sentiment has improved quite a bit. They're less worried about high prices. For them, these hallmarks of the American dream, fully within reach and probably already achieved. So from a macroeconomic perspective, we know that people with higher incomes generate disproportionate levels of consumer spending. So do I think spending is headed for a cliff? Probably not, because the people who have the greatest means to spend, who generate the most spending, they are not the ones who are feeling despair. They're not the ones who are feeling like these hallmarks of the American dream are becoming out of reach. But even if I don't necessarily think consumer spending is headed for a cliff, I don't think that the spending of middle and lower income families is based on a solid foundation. I think their spending is really being supported by strong labor markets and strong incomes and strong income expectations specifically. And if that starts to unravel, I do think that it is going to be very difficult for consumers in the middle and lower income groups to continue spending at the rate they are right now.
Okay, and not that you're calling for one, but if a recession should hit, you think that would really dramatically worsen the situation? True?
I mean, I think a recession is the recession is not going to help the situation. It is going to, if consumers, um, if lower income consumers are facing the prospect of unemployment or losses of income, it is going to absolutely, decrease their confidence. It's going to decrease their ability to spend, and it's not going to make them feel any better either.
Okay. All right. All right. I want to dig a little bit further here. One thing on the labor data, and this is not for you, Joanne. It's not what your organization digs into. There are a number of folks that I interview on this channel who do raise a lot of issues about the integrity of some of the labor market data, as we talked about, or as I mentioned earlier. If that then proves to be true, and the labor data isn't as strong as we currently think just by looking at headline data, it could mean that we're a little bit closer to the ledge, the type of ledge that you're talking about. Not saying you're calling that, and I'll keep bringing those experts on to try to help people better understand what may or may not be going on there. But let me get back to consumer spending for a second. So you've got the top tercile that's just going to spend because they're fine, right? But as we talk about, there's only so many jet skis and houses these people can buy, right? There's only so much of the 70% driven consumer spending GDP that they can make up for. Then you have everybody else. Everybody else is still seeming to be spending. A lot of that, an increasing amount of that spending seems to be happening on revolving credit, right? So if you look at consumer revolving credit balances, they actually it's something that doesn't happen very often, but they actually started going down during COVID as people were getting checks in the mail. But then they've since exploded, right? And they're at record levels, and they're at record levels of interest, right? So it's historically expensive debt that these people are now taking on. Presumably that can't continue forever. Where is the limit on that? I don't know. That's probably beyond our pay grade. But the folks are increasingly looking like they're putting more and more of their lifestyle expenses on plastic. And then I want to add in another quote of yours from that article. Consumers are so demoralized by inflation and high rates that they've given up on saving for the American dream and are spending money instead. So we have seen historically very low savings rates, right? So a lot of, on average, Americans are putting away a lot less than they used to. And we even have this like new terminology coming into the colloquial language, like doom spending, right? How much of, or what contribution does this have to keeping consumer spending high right now? Like I said, the top tercile, they're going to spend, but everybody else, is their current spending pattern, can we have confidence that it actually might weaken here, provided that the economy doesn't heat up again and there's better paying jobs for everybody, because they are putting it on plastic, which has some deadline at some point, some maximum at some point, and they're doom spending where you can't keep, at some point the savings runs dry when you're doing that.
As I mentioned, we have below average consumer sentiment and strong spending. And to me, that is a sign that consumer spending is not coming from a position of strength. And the delinquency data is consistent with that story. The delinquency data show that consumers are increasingly relying on credit. Relying on credit is not really a reflection of strength, especially if it's a revolving credit, which is very expensive. And so people are able to pay those bills right now, or most people are able to pay those bills right now because they have the labor market expectations, or they have the strong incomes to support it. But as I said, if strong labor markets is the main factor that's supporting consumer spending. If that starts to weaken, then this delinquency situation is surely going to be exacerbated, and consumers will not be able to spend, whether from a position of strength or a position of weakness. They just won't be able to spend. And so in terms of the doom spending, I do think that in today's environment, in which housing prices are so high, a lot of prices remain very high, that consumers don't feel like they have very much control over their financial goals. And that would be something that would drive consumers, if that explanation is true, that would drive consumers to spend in spite of the fact that they don't feel confident. And so that is an explanation that, again, squares the negative sentiment of consumers along with the high levels of spending, which typically occurs when consumers feel confident. And in this case, it does not.
Okay. And I don't want to put words in your mouth. I don't know if this is something that your data can tell you, but one of the concerns that I have, and it's shared by at least some percentage of folks that come on this channel here, is the wealth divide that we have in this country. And it has been increasing at an accelerating rate, and that was true pre-COVID. COVID really exacerbated that, right? And we've just been talking here about how a material percent of the American household base is basically giving up on being able to attain the American dream, right? Are we in danger, if this trajectory continues, of becoming really a nation of haves and have-nots? Really a departure from sort of what made America great, burgeoning middle class, which was a hallmark of America's prosperity of the 20th century. And I'm not saying we're getting there tomorrow, but you look at, say, sort of like, third world countries, or we could look to Latin and South America, where you see demographics where there's a very small kind of ruling elite, and then just sort of everybody else has many fewer prospects. It's a hyper bifurcated society. Does your data give you any concern or hope in this story, one way or the other?
I would say that the data it confirms my prior understanding over a pretty long period of time, since before I started working on this survey, which is that economically speaking, the US population is highly unequal, both in terms of income inequality as well as wealth inequality. Prior to my position here, I worked at the Federal Reserve and worked on the survey of consumer finances, which measures household balance sheets. So we were tracking household wealth inequality through the years. And I would say that the consumer sentiment data bear out what other data sets have shown, that the US is highly unequal by income and wealth. And the run up in inflation in 2021, 2022 was, in a sense, a great equalizer in the way people perceived the economy. There was this convergence between high and low income in terms of sentiment, in terms of the impact of high prices. And now I think and also at the same time, we saw over the last couple of years through the pandemic and after, a little bit of a reduction in wealth inequality and income inequality. The lower income folks saw quite a bit of wage gains that they hadn't seen in a really long time. And of course, though, with high inflation eroding those wage gains, I don't think it necessarily feels like a strong wage gain to people at the bottom, even if many of them have real wage gains. So I think that, yes, I am concerned about inequality. I wouldn't say I'm much more concerned than I was 5 or 10 years ago. There were some signs of some improvement or some reduction in inequality in the wake of the pandemic. But as you mentioned, we have these really strong asset market and asset prices, and that's not something that's enjoyed across the population. And so I do expect a widening of wealth inequality coming up ahead.
Okay. And I'm going to ask an unfair question, and I'm happy to cut it out in editing if you want me to, but especially given the fact that I just learned you worked at the Federal Reserve as well. If we put you in charge of, hey, you're going to run a commission to address the trajectory of wealth inequality, and the country will do with whatever your commission concludes. Are there any leading policy candidates you would want that commission to really investigate?
I think number one would be how can we control the cost of higher education? We've seen a tremendous reduction in public funding for higher ed, and so out-of-pocket costs, student loan burdens have all really been quite high, and it has made, while student loans has improved access, surely improved some access to people who wouldn't otherwise be able to afford college, the cost of college are still so high that it kind of it erodes the benefit of that degree if you have to pay for it with a lot of debt. So, I think that's policy one to take a look at. Policy two, I would say, or maybe a 1A and a 1B, would be figuring out the childcare crisis, and finding a way to support American parents. And if both members of a family want to work, to give them the ability to do so. And so, even though we don't necessarily think of those two things, among many others, as wealth inequality policies, I think those would both go a long way to helping alleviate the pain that comes from wealth inequality.
Okay, well, just editorializing for myself, I think those are two very worthy candidates. All right, well, Joanne, this has been wonderful. I know you're under time deadline, so thank you for coming on, despite the time deadline. But this has been a great conversation. I would love to extend the invitation to you, the open invitation to whenever data is released by your organization that you think kind of clarifies the road ahead, one way or the other. Would love to have you come back on and let this audience know about it if that's something that you're able to do.
Yeah, my pleasure.
All right, fantastic. So for folks that have enjoyed this, would like to follow you in your work, where should they go?
You should Google the University of Michigan surveys of consumers, and there we have all the details of our data, and it's updated every 2 weeks when we release new data.
All right, fantastic. And I will put a link to that in the description below the video too, Joanne, so that folks can get there with one click if they want to go check that out.
Perfect.
All right, very quickly, if you'd like to have Joanne come back on when she's got, like I said, clarifying data for us, please let her know by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. And Joanne, as we wrap up here, well, first, let me just remind folks, for everything Thoughtful Money, I won't give my usual pitch right now, but just go to thoughtfulmoney.com, and a reminder that you can click the newsletter link there right at the top of the site menu to get our free newsletter. All right, Joanne, in wrapping it up here, I'm going to ask you the concluding question I like to ask all my guests, which is, clearly you work at a highly influential organization there, doing very important work, helping us see the road ahead. What's one valuable lesson that you've learned over the course of your career that you think is worth sharing with people?
I would have to share something that I learned from Federal Reserve Bank of Atlanta President Raphael Bostic, who, when sharing with students of mine when I taught a college class about his career, he noted that he couldn't have necessarily prepared for his career path because he didn't know that opportunities were going to come up until weeks or a few months before those opportunities arose. And that struck me as very surprising at the time. But the current role that I'm in opened up because Richard Curtin, the previous director, had decided to retire after being director since 1978 for 40 years. And I never, since this job had never turned over during my lifetime, I never expected it to come up. And so just as President Bostic said, be ready when that door is open. And I'm so glad that I saw that this door was open and was able to walk through it.
Well, congratulations. And that's a huge testament to their respect for your abilities. And I don't know if you want to be there for the next 40 years, but if you do, I wish you a long tenure there. I have some other folks that have in the past sort of echoed a similar sentiment, which is, yes, put yourself to be able to take advantage of opportunity when it arises, but also put yourself in a position to take advantage of serendipity. Like
exactly.
Yeah. Put yourself in positions where serendipity can come find you, right?
Yeah.
And you were smart enough to do that. It happened, and then you were able to seize it as the door became available to you. So anyways, I think it's very valuable advice. We're coming up on the time. I promised I'd let you go,
Thank
Joanne. So
you.
thank you so much for joining us. Very, very useful. Look forward to having you back on the program in the future when you've got something you think is worth the audience hearing. And just thanks so much again for your time.
My pleasure. Thanks, Adam.
All right, everybody else, thanks so much for watching.